This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, the nightmare scenario begins, and I want you to see how it's going to break the economy, because we already have one very powerful force moving against the economy that has a perfect, and I mean flawless, track record of sending the economy spiraling down into recession, and in some cases, an all-out financial crisis. And now we have a second force moving against it at a time when we should not be seeing this happen. We almost never see these two paired together, and it's happening right now, and the consequences for the economy are outright dire. Plus, we have a sponsor for today's show. We have a biotech company who has a breakthrough for heart disease and ischemia with a technology that works. And what also works is their chart setup. As I'll show you, we think there's a 33% move in the short term to the upside. Stay tuned to the end of the show for more information, or check out the pinned comment or the description below. Now, if you're wondering what we're doing back home, well, the services sector is also in the news, and what better place to zero on and what's going on in the leisure and hospitality space than my own backyard. Let's go to Bloomberg, where we picked today's story up with a headline: Treasury rout unnerves traders as stocks retreat and markets, well, they're in a big conundrum right now. And this is something that we normally don't see at this time, is a big move in the interest rate market. And I want you to see just how bad this force is when you pair it with the already existing force moving against the economy. It just says that there's actually no hope now. The whole system could break at any time. Treasuries deep into sell-off, driving the 10-year yield to a 9-month high, and that furthered today as equity slumped and investors are now getting increasingly worried about borrowing costs at a time when you hear most investors say that they want higher interest rates, that they think interest rates are far too low and they need to go up substantially. But suddenly there seems to be some worry, but it gets even worse. The S&P 500 extended Wednesday's losses into Thursday a bit before turning around by mid-morning. But look at this. You see here, added the bearish move by announcing, this is, of course, Bill Ackman, that he's shorting 30-year treasuries as a hedge on the impact of higher long-term rates on stocks. Now, what is he talking about here? He actually thinks that long-term rates go up in this setup. We're going to make the case of why he's completely wrong and why this is a big problem. But nevertheless, what happens, investors start to look at the equity market that's gone up a bunch and start to make the cases, can I make enough on the equity market plus a risk premium to beat what the risk-free treasury rate is? Well, some people say, no, you can't. In treasuries, given the recent rally in stocks, especially on the NASDAQ, there's a lot of sensitivity to rising yields. In fact, in Europe, a lackluster earnings season is also weighing on the outlook. So many are taking the opportunity to implement a more bearish positioning, and what that means is actually selling out of equities and moving into bonds at a time we're seeing bond prices just get hammered. And we're going to talk about why that is and why it's such a huge problem. The bond selling has come on the heels of robust U.S. economic data and news that the Treasury will issue $103 billion of securities next week. Now, let's back this up a second. Robust economy? Are they crazy? Go back to 2019. It was far worse. And what was the Fed doing then? They were cutting rates. They were doing QE. Today, similar setup, and everyone says the economy's better? Well, it's actually, the data says it's worse. But this is more about what the Treasury is doing, or at least how the market's interpreting it, than anything else. In the decision by Fitch Ratings, of course, we talked about the stripping of the credit rating. That really doesn't matter too much. But right now, long-term U.S. debt looks overbought, which is interesting because one might think it's oversold. But they're looking at it from a supply and demand perspective, asking how the market is going to cope with the increased issuance. Of course, Bill Ackman said, without materially higher rates, well, nobody's going to buy this stuff. And of course, we keep hearing this. Since I've been a kid, we've heard who's going to buy this stuff, and yet buyers are eagerly there at almost every auction, even when the Fed's not in play, buying up the debt. Because again, you start to look at, can the market outperform the risk-free rate? Well, that starts to become a question. But it's what these higher rates are doing to the economy right now are something that they shouldn't normally do, and it's posing a big problem. Meanwhile, Warren Buffett, on the other hand, says he's buying treasuries at the tune of about $10 billion a week. And here's the issue. So let's talk about the very first problem here, because what I want you to understand as we get into this chart is people like Bill Ackman think we're going to see what's called a bear steepener in yields on the yield curve. What that means is he believes that long-term yields are going to go up, and he's saying they're going to go up a lot because he believes they have to go higher than, of course, short-term rates to cause the yield curve to uninvert. Now, if this were true, you have to keep in mind he's taking it from a supply and demand of treasuries issue, which has never ever in the history of the market been a factor. Now, in the short term, it can matter, but on the long term, has absolutely no bearing on yields whatsoever, with the exception of the more debt the government takes on, lower yields is what we typically see. But the real issue we should be talking about is what the impact on the banks. So here, as we're looking at what the belief is, this bear steepener means the yield curve's going to go up instead of the traditional bull steepener where you see long rates and yields go down. But what this means for the banks, and this is what I want you to really understand here, is the banks are already hemorrhaging, because what's the big problem with the banks right now is they have these unrealized losses from rising treasury yields. So Bill Ackman is right and continues to short the bond market, which we noted in yesterday's show, seeing about record short levels right now. And if you know anything about the markets, when everyone's piled in on one side, usually the opposite tends to happen. But from the bank's perspective is if they're already seeing these losses on their bond portfolio, what does that mean? More support. They're going to need to turn to the Fed, need to turn to the Federal Home Loan Bank, because they're going to need to compete with these higher rates, and they don't have the ability to do it, putting more stress, leading to potentially more bank failures, possibly more mergers, as our Treasury Secretary Janet Yellen has suggested are going to happen. And that's not a good sign, because ultimately, when the banks are under pressure, what do they stop doing? Well, they stop lending. And that's what we're seeing right now, being the first force against the economy of the two. We see, of course, these rising, you notice here, the net percentage of banks tightening lending standards. Well, if you think it's bad now, wait till the curve steepens. As you can see, it gets worse. Now, traditionally, what we see is yields falling. But regardless, if yields rise, as long as the curve is going the wrong direction, the banks are in big trouble. And the second, as you start to dig deeper in here, what this leads is tighter lending standards lead to the less creation of lending. And so here you can see we've got commercial industrial loans overlaid, and notably, when banks tighten lending standards and curtail lending activities with absolutely no shock to anybody, what happens is commercial industrial loans on a year-over-year rate of change here in red start to decrease and typically go negative. And that has implications for the economy, because we're running right now about a 3% year-over-year rate of change. This thing is headed likely negative here in the not too distant future. So think of this from the bank's perspective. You've got deposits, which are a liability. You need to back them with an asset. As you're watching those liabilities leave because people are chasing higher rates elsewhere, thanks to the belief of people like Bill Ackman. But here's the problem. If you see a net decrease in your assets from your loan book that are backing your cash deposits, you have to go get a different kind of asset to back them. And that's going to be the second part of the story here. I'll let you think about what that might be that the banks will need to buy in droves. And now we see the BOJ intervenes for the second time if there's really an issue on the bond market. This is what everyone's saying it is. And this week, to slow the yield spike. So here's the belief that somehow the U.S. Treasury market is not control of itself at all. In fact, now has everything to do with Japan. I'm going to show you why this is the case, at least why they're making the case, and why you're seeing this big move in yields happen in the overnight market. The announcements of the unscheduled operation Thursday came after the benchmark 10-year note, this is the JGB, touched a fresh 9-year high of whopping 0.65%. Now remember, put this in perspective, the 10-year treasury yield's over 4% right now. And so what's happening is the BOJ stepped in and bought around $2.8 billion of securities to slow the increase down. And part of this comes back to the prospect of an increase in JGB yield is rippling through global bond markets, because Japanese investors with ultra low interest rates at home are the biggest foreign holders of U.S. government debt and own everything from European bonds to Brazilian notes. They love debt. And each incremental yield gain at home, keyword, may boost the incentive for them to repatriate funds. Of course, part of this issue has to do with the fact that when we see this happen, it has everything to do with hedging costs in the currency market. But now let's come back to the second force. The first one being banks tightening lending standards. Perfect track record of a recession. We've seen it cause a financial crisis, and now we see the added on to that, the market trying to push rates up in the short term. And I want you to see this is something that we normally don't see happen here, because when banks tighten lending standards, and I want you to understand this, we see money creation as the blood of our financial system. So when, of course, financial conditions tighten and less money is created, what do you normally think should happen to get people to borrow more money? Do you think rates should go higher or should they go lower? Well, if you said lower, you got it right. And here you can see as lending standards tighten, again shown in blue, that's any time above that horizontal black line. What do we see? Rates go down because at some point the monetary system, the financial system itself, and it doesn't matter if everybody like Bill Ackman is short or everybody like Warren Buffett is buying, you see rates fall because what's happened is as we starve the system of money, rates need to fall to get people to borrow. So what we're seeing now is something we normally don't see, and that's the market try to push rates higher because they think we have to have a bear steepener. We have to see that rates go higher, and now that means, as we can look at the next chart, is when we now come back to commercial industrial loans, now shown in blue, we put that against U.S. Treasury securities at 10-year. What do we see? Is when, of course, that commercial industrial loans go down, we see rates fall together with it. You see it happen over and over again. And the question you might ask is, well, wait a minute, how is that possible? Now remember, banks have to back a liability with an asset. They can either go out and lend or they can buy treasury securities. And so what's about to happen as we see commercial industrial loan growth go negative and more loans get paid off than originated, well, that means the banks are going to be buyers of bonds in a massive, massive way. And that says interest rates are likely to go down. There's going to be a monster short squeeze. But putting to the point to Bill Ackman, who we're putting on trial in today's show, they've got it wrong. And here we can see the consumer price index headed down, and you can just note, I've got 10-year treasury yields. There's been only like one really major time we saw yields rising against a falling CPI, and look what happened. They came down and made new all-time lows. In fact, you tend to see there's somewhat of a relationship. As inflation rises, you see yields come up, and as it comes down like now, you see yields fall, again, coming back to the demand issue. Not the supply and demand for treasuries, but the supply and demand in the economy. If demand is coming down as the inflation comes down, well, rates need to fall to get people to go spend. And here we can see again, looking now at a different perspective, the Philly Fed General Activity Index that's shown in blue, looking at the economy. We see again one case here in the early 90s where yields in red were going higher, and what happened? The economy was going down, and next thing you know, yields started spiraling to the downside. Here we can see diametrically opposed each other, tells us that the real path for yields is lower, not higher. So when you pair the fact that financial conditions are tightening at a time when yields are going up, and what did we just learn from the SLOOS, that Senior Loan Officer Opinion Survey? What did it tell us about demand for new loans? Was it going higher or lower? Well, if you remember, it said it was going down, and that's not exactly a good sign for the economy. Those two forces together all but put a certainty of a major recession, if not an outright financial crisis, now focused in the coming months. And something else that everyone was banking on was the services sector. And again, this is why we're back home, because we've got a lot of people employed here, and let's check out and see if they're going to be here much longer. As U.S. services sector activity expanded at a slower pace in July, keywords, slower pace. Remember, the services sector was supposed to lead the manufacturing sector. The majority of respondents are cautiously optimistic about business conditions in the overall economy, notably cautiously, while the manufacturing sector has struggled under the weight of rising interest rates and a shift in consumer spending preferences. The services sector, a much larger part of the economy that includes travel and other experiences, has proved to be much more resilient, at least for now. I can tell you here, right in the own backyard, demand here is coming down. It's softer than it should be. People are starting to ask questions. And as I've said, the issue here is the media doesn't get it. The services sector follows the manufacturing sector with a lag. Let's take a look. Here you can see from the ISM Services PMI, it slowed to 52.7. Normally, this is the 7th consecutive month for an expansion, but it's expanding at an ever slower pace, suggesting momentum is dying down. And here you can see it went last month at 53.9 down to 52.7. And look at this business activity. It's still running fairly decent at 57.1, but it's slowing. We see new orders still growing, but not as fast of a pace, but still at a decent pace. We'll say respectable pace. But look at this employment. Everyone's talking about employment of the labor market. Well, it's now virtually unchanged last month, suggesting not even the services sector is hiring. And why might that be? Well, we've seen a backlog of orders turn slightly positive after several months of contraction. We'll look at that a little closer here. And prices paid, well, they're up a little bit. So suggesting there is some demand in the services sector, but it's starting to abate pretty quickly here. Let's take a look at the backlog of orders here, and here we can note that what we see here is a mild, unchanged in April, then look, a contraction in May, big contraction in June, and now stabilizing in July. And all that turn, we know that when backlogs are cleaned out, employment goes next. Here we can see in April unchanged, May unchanged, June up slightly, July unchanged, suggesting that as we look to the non-farm payroll report tomorrow, one thing we can expect is it shouldn't be a pretty big number. Now we can know, of course, the BLS probably going to cook the books like ADP and give us a big number, but look, the number is going to come down at some point because the manufacturing sector is laying off a little bit and the services sector is not indeed leading the manufacturing sector. As this next chart shows, it's about to head lower as we see the ISM manufacturing on business employment in red against the ISM business employment in the services side in green, suggesting that, again, where the red line goes, the green line follows with a lag, telling us that the days for the services sector are coming to an end here in the not too distant future, as everything in the economy is now going to get bound under higher rates and tighter lending conditions. But now I'd like to introduce you to our sponsor for today's show, Hemostemix. Let's take a look at them. Here is their website. Of course, we've got all the information in the description and the pinned comment below. You can find them on the OTC under HMTXF and on the TXSV under HEM. I want to share with you who they are, what they're doing, and why I think their stock could head about 33% higher here in the short term. Hemostemix is a clinical stage biotechnology company focused on developing and commercializing proprietary autologous cell therapy to treat ischemic diseases. The proprietary platform technology is based on more than 10 years of clinical data demonstrating the ability of our autologous cell product to generate diseased and damaged tissue. Our efficient, scalable, and cost-effective platform has the potential to generate therapies for a broad range of ischemic diseases. ACP-01, our lead clinical stage candidate, is an autologous cell therapy for the treatment of critical limb ischemia. And ACP-01 is currently in a phase 2 clinical trial in Canada and the United States. Now let's take a look at the chart setup, because I think this is a really interesting story here. We're on the 5-year chart. Now you'll note that we see the RSI is pushing up, so momentum has been kind of bouncing off oversold space here, and it's now starting to move a little bit higher. And you'll note I've circled the volume profile. It's sitting right above the 200-day moving average at just around 17 cents. And I just spoke with the CEO yesterday, and he is a great guy, and he told me, he said, Steve, most of the board, most of our executives have been buying the stock with our average purchase price right around 20 cents a share. And he said, look, it's a bargain right now. We think this thing could only go higher. And I totally agree with him. So I want you to see, when we look at that volume profile line, who's there? Well, that's the insiders looking to see their stock go a whole lot higher. As Hemostemix is the first most affordable autologous stem cell therapy company approved to treat critical limb ischemia and ischemic cardiomyopathy. And they have 93.5% of ACP-01 treated limbs were saved from the amputation in phase 2 trial. Let's take a look at their technology application. They use their patient's own cells, and it's a really simple process, and it's quick. It only takes 7 days, and it has the potential to non-invasively treat patients with severe critical limb ischemia. And treatment with ACP01 involves just extracting and enriching the desired cell population, again, from the patient's own blood and putting it right back into the vessels of the dying tissue. Let's check this out because their technology application has low patient risk. It's a simple protocol. There's no reported safety issues. It has high cell viability. It's scalable. And again, from an investment standpoint, that's fantastic. And there's no ethical concerns. Let's take a look again at the chart, this time at the 2-year mark. Here you can see again that volume profile sitting right at 18 cents. There's all the insiders, and now it traded just recently as low as 7 cents. We see the MACD making a positive cross coming up from that oversold space. We see the RSI starting to move up. Our initial target is 12 cents. That's a 33% move to the upside of what we think the first move is before it goes even higher. And they have a 7-day scalable process that starts with blood collection and shipping, isolation of the SCP, culturing and differentiation of cells, then cell harvesting, a quality control, package shipping, and then administration. And you can again find them on the OTC under HMTXF and on the TXSV at HEM. And they can scale this in a big way. This was something the CEO really wanted you to understand. He shared with me, he said, look, we can turn this up and be very profitable. Phase 1 this year, 20 batches, going to 40 next year, 60 the year after, 72 after that, and up to 4,000 batches per month at 2027, making hemostemics the potential for a big move in their stock price higher as more people actually can access their technology because of their low price they're going to be entering the market at. And here we can see that 12 cents target to the upside. There's your 33% move. As we look at the 90-day chart, you see RSI moving higher, you see the MACD moving higher, and again, you can find them on the TXSV under the symbol HEM and on the OTC under HMTXF. And with all companies we feature on our show, you're under absolutely no obligation to purchase their shares. Be sure to do your own research before buying or selling any stock. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.